All righty, and it looks like we are live. Well, hello everyone, welcome back. We are here today for another series in our Tax 101 Facebook Lives, where we are getting you all primed and prepped for the 2022 tax season. We hope that everyone has gotten off to a great start this new year, and we are glad to those who have joined us again from last week. And today, the topic of discussion is going to be on the Earned Income Tax Credit. So we are here today with Jennifer Schinke and Peter Lindsay of Inland County's Legal Services Low Income Taxpayer Clinic, and they're going to walk you through the details of the credit, the eligibility requirements, and the common mistakes that people make when they are filing for the EITC. So Peter and Jennifer.
Hello, everyone.
Hello, everyone.
Awesome. Well, maybe to start us off, can you just break it down for us and tell our viewers, what is the Earned Income Tax Credit?
So the Earned Income Tax Credit, otherwise known as the EITC, is a credit to help low-income working taxpayers by providing a refundable tax credit to those who qualify. So if they have low income and they are working, meaning that they have earned income, then they can claim this credit and on their tax return, and it's a refundable credit.
Cool. Well, yeah, that sounds like a great deal for some folks. So who qualifies for this tax credit?
Yeah, so in order to qualify for the tax credit, you have to have first of all, you have to have earned income, and that means income from employment or self-employment. Income streams coming into your home that are not earned don't qualify you for the earned income credit. And so those would be things such as unemployment, Social Security, alimony, child support, workers' compensation benefits, and investment incomes. And that's not all inclusive, but those are the main ones. And so you must have some form of earned income. Another qualifying event is that you have to have both you, your spouse, and any children you're using to help qualify you for amounts for the EITC have to have Social Security numbers. So if you're an ITIN holder, you won't be eligible for the EITC, unfortunately. And you also must not be married filing separately. Using that filing status will not allow you to do the EITC. So if you're married, you must do married filing jointly in order to obtain the EITC. And you must not have investment incomes more than $3,500.
Okay, cool. So, you look at kind of those requirements and you do determine that you are eligible, then how would this tax credit be calculated?
So there are two factors that determine how much the earned income credit a taxpayer can claim on their return. The first is the number of qualifying dependents or children, and the second is the amount of the household income in the family. So for 2021, if you're not claiming any children, then the maximum adjusted gross income for an individual or someone filing head of household would be $21,430. Married filing jointly, $27,380. And the maximum amount of credit that can get refunded or applied would be $1,502. So that's not bad, but if you move all the way down to someone that's claiming 3 dependents or 3 children, then your household income can be up to $51,464, and for married filing jointly, $57,414. And depending on your income, and which we'll talk about that in a little bit, you can get up to $6,720 for the earned income credit. So regarding the income that you make, and the credit that you get back, that's determined through if you can picture what's a bell curve. So which means that if your reported adjusted gross income is very little, then you're not going to get a lot of that credit claim. But if you have a moderate income, that's when the bell curve starts going up, and the earned income credit starts increasing, and then it starts capping off and tapering down after your income reaches a certain level, and it starts increasing to a higher level. So once you hit that, let's say for married filing jointly, the 57,414, then you're going to get reduced. Your earned income credit is going to get reduced to a pretty low amount and tapering down to zero.
Awesome. Yeah. And we did also drop that eligibility chart in the comments below. So you should be able to look and kind of see, if you fall somewhere on the spectrum where you would qualify. And it seems like, this is a great deal for people with children if, they meet all of the eligibility requirements. So kind of on that note, who is considered a qualifying child for the EITC purposes?
So in order to be considered a qualifying child for EITC purposes, meaning to be considered in the amount of children for the amounts that you receive, they cannot have filed a joint return with someone else, usually meaning they're not married, and they also must meet a three-pronged test. This three-pronged test includes that they have to be related to the taxpayer, meaning they have to be related to you in some way. They lived with you for more than half the year, and they are 19 years of age or younger, or if you can prove they are a full-time student, 24 years of age or younger.
Got it. And then, so who would be considered as related to the taxpayer?
So that is, put it simply, someone with a blood or legal relationship to that filing taxpayer. So obviously directly you have your son, daughter, and then legally stepchild, adopted child, foster child. And then with blood relationships, you can also claim, your brother, sister, half brother, grandchild, or niece or nephew. So if they're living with you and they have a blood relationship, then you can claim them.
Got it. And so one of the prongs that Jennifer had mentioned is that the dependents have to be of a certain age. Are there any exceptions for dependents who are over those, the qualifying ages?
Yeah, so once again, those qualifying ages they have to be under the age of 19 years old on December 31st of the year that you're filing for, or under 24 if you can prove that they are a full-time student. There is only one real exception to that rule because, again, it's meant to be for the children, qualifying children. One exception is any age and the dependent is totally and permanently disabled at any time during the year. So permanently and totally disabled parents or children, generally is where we generally see this.
Got it. Definitely. And then what if the child in question lives with more than one parent? What are the rules for residency?
So the residency rule is also can be laid out in simple terms as, the child must have lived with the taxpayer that's claiming the EITC for more than half of the year. So it's more than 6 months and 1 day. And they have to live within the 50 states, District of Columbia, or military bases, and areas that are not included are Guam, the Virgin Islands, or Puerto Rico. So if the child was born or died during the year of which you claim the EITC, then they lived with you for more than half of their life during that year. We consider that more than half their year for claiming the EITC purposes. If your child was temporarily away from home, that time can also be counted. So, for example, the claiming relative may have a temporary leave for illness, school attendance, vacation, even detention in a juvenile facility, or kidnapping. Those would also be circumstances that would still count for the EITC.
Okay, got it. And then what about if the child is the qualifying child of someone else?
Yeah, so sometimes under certain rules and regulations, the child can fall into being more than one taxpayer's qualifying child. This can include when two parents are divorced, or sometimes there's the parent and another relative. And so sometimes there is some fine lines, or you really do have to consider who the qualifying child is. However, only one person is allowed to claim the child every year. So there has to be some kind of agreement as to who's going to claim the child, or you have to use some of these other rules to come up with who legally has the right to claim that child.
Got it, definitely. So it's best to, come to an agreement beforehand before filing for this credit. But what about those scenarios where the parents can't agree on who will claim the qualifying child?
So if both parents want to claim the same child, only one parent with whom the child lived with the longest during the year can claim the child. If both parents want to claim the child and the child lived with each parent for the same amount of time during the year, then only the parent with the highest adjusted gross income for the year can claim that child. So you see how the IRS uses it so that the higher the gross income, the lower the EITC that they're going to have to pay. If a parent and a non-parent both want to claim the child, then only the parent and not the non-parent can claim the child. And if two non-parents want to claim the child, then it goes back to the higher AGI rule where the non-parent with the highest AGI can claim the child.
Got it. Yeah, definitely. And then so, a taxpayer has gone through all of this, they've determined their eligibility, and they have filed to receive this credit. What happens if the IRS denies one of the claims to the EITC?
It's not a completely uncommon thing for the EITC to be denied. And so basically what you would do is, and this is something our office can and does help with. So if anyone wanted to reach out to us, if that happens to you, but what you would need to do is kind of review why the IRS says that you don't qualify for the EITC. And from there, if you still feel that you are entitled to it, you would need to appeal their decision. And a lot of times that would include written statements and giving them supporting documentation as proof that, no, you're wrong. I am entitled to claim this dependent, which is generally a lot of the times the problem, or some other issue. If you don't appeal, then so sometimes, depending on the circumstances, you may be barred from claiming the EITC for the next 3 years. And if they find that you did it too fraudulently, meaning that you ultimately knew for a fact you didn't qualify and you did it anyway, then they can stop you from doing it for up to 10 years. Once you're eligible after being banned, you do need to file an 8862 if you've previously been denied the EITC for them to finally accept it in the upcoming years.
Yeah, definitely. So, it is really important for folks to kind of check on those requirements and keep tabs on how your claim is doing. And we did post a link to an IRS document that goes into some more details about the EITC. So then what happens if the IRS sends you a letter asking for supporting documentation for this tax credit?
So it's really not that uncommon for the IRS to send a letter asking you to provide or prove that you qualify for the EITC. As you can see, the amount of the EITC, it can be kind of pretty substantial. So that, sometimes they want to audit to make sure that, the people are rightfully claiming the credit. You have to make sure that you're prepared with these documentation. So you have to, number one, show that blood relationship, and usually that's with birth certificates or court papers showing that, you have legal custody of the child. And then you have to show that residency requirement. And so residency requirements often can be shown through school records showing that, where the school records show that the child lived at your address for more than 6 months. And if you don't have the school records, then get medical records showing the same. It can get tedious sometimes trying to get these records to show that residency, but that's what you're going to need to do if the IRS asks for those.
Yeah, absolutely. And I think that was a great introduction to kind of some of the basics that people should know when they are, trying to claim this tax credit. But maybe can you guys talk about some of the common errors that people make when claiming this credit and some of the, the things that they should keep in mind?
Yeah, so one big one and one major one is people claiming a child that doesn't meet the residency and relationship requirements. When you're filing a tax return, you want to review those and make sure that the child in question did live with you for more than half the year. Physically, truly, or truly plus some of those exceptions that we talked about earlier, and also meets the relationship requirements. Are they legally, or are they blood or legally related to you, or a descendant of one of those people? And so you want to double check those things before you file. Another thing is married taxpayers filing single or head of household. For whatever reason, that can be a problem, because once your filing status is wrong, then that changes your rights to EITC, which can make you owe back money. Incorrectly reporting income, and this happens particularly in Schedule C circumstances, because they have the 1099s, but then you're giving the expenses, and sometimes they can be off, and that affects the EITC. Another one has to do with social security numbers, missing or incorrect social security numbers for yourself, your spouse, or your qualifying children. So you want to make sure that all of those numbers on the tax return that's filed with the IRS are accurate. Otherwise, it will slow down the process. And again, if you incorrectly claim the EITC, but you're not eligible for it, that may cause you to be barred for 2 years.
Definitely some good stuff to keep in mind for those who are hoping to, claim this credit this year. And for those, who are approved for this credit, will the EITC affect a person's public benefits?
So short answer is no, the EITC will not affect your eligibility to collect public benefits such as food stamps, low-income housing, welfare, Medi-Cal, and Social Security, supplemental Social Security income. The EITC will not affect the amount of these public benefits. However, if you do not spend the EITC within a certain period, it could affect, what you show and how they claim the certain benefits. So spending is what might affect it.
And if you've listened and you feel like you do have issues with the EITC and you need some help with the IRS with the EITC, we are more than happy to assist you. So don't hesitate to give us a call if you need some further assistance.
Absolutely. Yep. Our low-income taxpayer clinic is here to help residents who qualify, whether it's an issue with the EITC or, another tax question or problem that you've run into with the IRS. We have great attorneys on staff like Jennifer and Peter who have seen the problems that people have. They've seen almost everything under the sun, and they can certainly, help work with you to find a solution. And thank you everyone so much for joining us again for another Tax 101 series. We know this one went a little bit longer than the previous ones, but there are just so many details and specificities for the EITC that are really important to know and familiarize yourself with before you file your taxes this season. So thank you all so much for joining, and please give us a like on Facebook. We'll be hosting more events in this series, and that way you can be notified and stay in the loop. And I don't think we have received any questions, so I think we are going to call it a day. Thank you everyone for joining, and we will see you next time.
Thank you.
Thank you, everyone.